Hello and welcome to Insurance Business TV for our Property Insurance Power Panel. We're going to take a look at the latest March quarterly Global Insurance Market Index, which showed that property premiums in the Pacific, including in Australia, have declined by 14%. We've summoned our experts. We've got Jodie Geraghty, Account Executive with WTW's Corporate Property and Casualty Division. She's in Brisbane. Melissa Jolly, Managing Director of Pinnacle Insurance Brokers and based in Perth. And Martin Birch. He's Principal with Agrisurance based in Sydney. Welcome to all of you. Welcome back again. Martin, let's start with you. 14% decline. Are you seeing that level of decline? And if so, how is this impacting your client discussions and the types of coverage clients are now able to secure compared to previous months?
Well, Daddy, welcome to all the panel members. Firstly, the Marsh report is based on a mix of property within the Marsh property portfolio. So the first thing that sticks to my mind is that it's a representative sample of the Australian market. And I see three sort of takeaways, both in the composite rates and the property rates. I know we're more interested in the property rates, but if I may just have a look at three things. On the composite rate, the first thing that I see is 17 consecutive quarter trend in rate reduction. So that's 4 years from a high in quarter 3 2021 to where we are today, to quarter 3 2025. The size of that drop in premium rates, to my mind, is a whopping 28% reduction. If the motor vehicle market was subject to those kind of swings, a $100,000 Land Cruiser in 2021 would now be $72,000 in 2025. That's amazing. But I see a stabilized price trend now. The last two consecutive quarters have remained constant at 11%. And so I know we'll talk about the trends later, but to me that shows that we might be nearing the bottom of the trough, certainly for the composite rates, which is all lines combined. When we look at property rates, again, there's a consistent price trend downwards for 17 consecutive quarters. There might be one that was not consistently down. And again, that's from the last high point in the cycle of 2021. So that also, observation 2, is a 25% reduction, which is a big swing. And lastly, just the report speaks about a rate reduction of 14%. Just to be clear, as I see it, it's a 14% reduction relative to a baseline being quarter 4 2023. That's when the rate of change or the change in rates was flat, 0%. It's not compared to the high in 21, because that's 25% reduction to today. And I see a long downward trend, but the last two quarters for property are still reducing. And again, we will talk about this later. It suggests to me that we haven't reached the bottom of the trough of property rates. So in terms of rates in my patch, SME space mainly, yes, rates are down. And in terms of client discussions, clearly it's a good time to be a broker, and underwriters seem to be a lot easier to get hold of. They tend to pick up the phone a lot quicker. They're more responsive to general negotiations. And that is for good business, though. I'll qualify that a bit later.
Thanks, Martin, for that very good rundown. Jodie, how do you see this 14% figure?
Yeah, thanks, Danny. And thanks, Martin. You've summarized the Marsh findings essentially for me. So yes, I am in the corporate space, and I've definitely been seeing reductions in premium rates. It does differ based on clients and industries and whether they're in North Queensland or South Queensland. So it definitely seems to be that kind of overall value rather than split out as to geographies and those sorts of things. For me, I note that the best rate reductions are often after negotiations with the underwriters. It's not always the first rate proposed by the underwriter. With the premium rate reductions continuing from the last half 2024 and through 2025, it means all my clients have had time in the softening market to go through a renewal. in general, it's been really pleasing for me to be able to deliver the good news of the rate reductions as well as more favorable terms through enhancements in some limits, conditions, and exclusions. There was a long period of having more challenging conversations with clients whereby, even though as brokers, we've done everything we possibly can to bring the best terms to clients, due to the hard market conditions, it was still not exciting news and often difficult for clients to swallow with ever increasing pressures of their budgets. Martin's point, there are exceptions for clients with challenging risk exposures or significant claims activity, but I believe we'll touch on that in a little bit later.
Thank you, Jodie. And over to you in WA, Melissa. Are you seeing that 14% level of decline?
Hello, and I'm back. Thanks for having me back. We are seeing a softening trend, but I wouldn't say the 14% figure is universal in WA. It is a very large state, as we all know, and the weather and perils that we experience in the north is very different to the southern parts of WA. I'd say in metro and lower risk commercial segments, we're seeing reductions between 5 and 10%, so not quite that 14% in the Marsh report. But as my colleagues have mentioned, it does depend on the quality of the risk and the loss history as well. So for higher value, well-managed portfolios, especially where the insurers are competing for renewal business, the declines can be a bit sharper. But for clients, it's at the end of the day, it is definitely a welcome change in tone. The conversation has shifted from how do we minimize increases to what improvements can we make to attract better terms? So there's also a broader appetite and flexibility around coverage enhancements, particularly on limits, deductible options, and reinstatement clauses, compared to where we were about 6 months ago.
Let's turn now to the distressed areas of the property market. You've all alluded to that a little. Let's focus on properties that are impacted by nat cats and other high risks. Are they seeing declines as well? And if you're seeing declines, is that actually making any difference to affordability? Jodie, what's your take on that?
Yeah, I wouldn't necessarily say there are declining premium rates for distressed areas of the property market, at least not all of it. Rather, the ability to pull on different levers has become available. So the most noticeable shift I've seen is the willingness for insurers to include cover for natural catastrophes or quote higher natural catastrophe limits than previously. This does usually come with a trade-off of a higher excess or increased premium rates, but the opportunity for the cover has increased in the last 12 months. Insurers are still underwriting risks on a case-by-case basis, so clients with a good understanding of their risk exposures and strong risk management are getting more favorable rates and coverage. These are the clients which insurers are willing to compete for and where the best renewal outcomes are being seen.
And Melissa, what are you seeing over in WA?
Yeah, in WA, I'd actually say yes. Even in some of the higher natural peril zones, like the northwest with the cyclone exposure, we are seeing a slight easing in premiums. Notwithstanding, we are entering a different season, and bushfire season, everything is on the approach. So watch this space. But it's nowhere near the same rate of decline as low asset risks, of course, because the insurers do need to allow for the difficult seasons. But there is definite stabilization and in some cases a small reduction, which is always positive, and it is a big change from the past few years. So for clients in these areas, the difference is more about consistency and availability rather than massive price drops. And some insurers who have stepped away are cautiously re-entering, which is good. We try and encourage them back in, and it does help create options and that supply and demand within the market. So the challenge remains that underwriting is still very selective, and property condition, location, and construction standards all play a major role in determining how much relief clients actually see.
And Martin, I expect you'd broadly agree with that. For distressed parts of the property market, the insurance cover is still pretty hard to place?
Yeah, what has been said chimes with my view. We're talking distressed areas, and I think they remain difficult. Underwriters will rather reduce rates on good property risks than compete aggressively for poorer risks with a history of claims and older buildings or stuff that's not well maintained or built in a poor state of repair. So the soft market favors good risks more than they alter the underwriter's appetite on poor risk. It's just the relative appetite is more pronounced. They're not more favorable, they're just less unfavorable. So the insurers generally are prepared to offer, it's more accessible, I think, as Jodie was saying. They're more willing to entertain higher limits or lower deductibles. But again, poor properties that in a poor condition and below par risks, it's not all plain sailing. It's just less unfavorable.
And Martin, let's stick with you and talk about some general insurance challenges for you in property. What are a couple of your main insurance challenges right now?
Well, first of all, underwriters in the current environment are having to compete heavily for business, right? They've got to protect their existing book of business, and they'll still have some kind of growth targets. And what's happening is there's a lot of shopping around. Brokers are shopping around a lot. So what I'm finding is they're actually slower turnarounds because there's more backlogs, and that time is becoming more of an issue, so that we actually need to make sure you've got ample time when you talk to underwriters. So that's one point. And the other one is that I still sense an increased focus on risk management. It may just be a pet topic of mine, but I sense that there's an increased emphasis on that. So like, whilst ISR as a product is probably seen first and foremost as a property-based product, the business interruption Section 2 component is seeing underwriters focus more on risk management evidence, because depending on the occupation of the client, the propensity or the ability of a business to bounce back from a fire loss or a covered loss in a Section 1 is important to the underwriters. So they want to see BCP's business continuity plans and documented policies and procedures in place. That's my take on it.
And what about you, Melissa? Are you seeing underwriters wanting more of a risk management approach?
Yeah, definitely, which I know my colleagues here have mentioned timing, and you always feel a bit under the pump and time when you're waiting on insurers or waiting on clients. I would say that the biggest challenge remains affordability versus coverage. Even with rates easing, which is a good thing, premiums are still high compared to pre-2020 levels before all those bushfires and floods that happened. And cost pressures like rebuild, inflation, and compliance requirements are still in play. The other key issue is insurer appetite volatility. So some markets are coming back in, which is great. Others are tightening again on certain occupations or regions. So it's finding that balance in the market, and as a broker, managing that landscape and setting realistic client expectations takes time and clear communication.
And Jodie, let's move on to you. You've said that having proactive clients is something that's quite important right now.
Yeah, Danny, I agree with Martin and Melissa. And to the point of the proactive clients, essentially, if they're proactive and they're positively engaging with their broker, the ability to get information to the insurance markers, whereby underwriters actually have time to review it, to understand it, to ask questions, and then revert, is where the most competitive premiums and terms are being achieved. It's a basic concept, but underwriters are busy, especially with the copious amounts of remarketing occurring at the moment that Martin mentioned. So getting to them with ample time can be challenging depending on your client, but absolutely worthwhile. There's only so much in a broker's control, but to start the renewal discussions, education, and information gathering early with your clients has a positive flow-on effect to the renewal outcomes.
And before I let you get back to work, let's have another look at this Marsh report and this downward trend in insurance rates. Do you see this as sustainable, and what sort of thing could reverse this? Melissa, let's start with you.
Yes, so for now, the softening looks sustainable in the short term, which of course is a good thing, but it is unlikely to last indefinitely. So if we see a major natural peril event, such as severe cyclones or bushfire season in the north, which is coming, it could change quickly the complete tone of the rate reductions. That said, there is a good balance in the market right now, which is very pleasing. We've got adequate capacity, lower losses, and steady competition. So, like I said, unless there is a major shock or a big shift in reinsurance pricing or a big natural catastrophe, we'll probably continue to see a controlled, stable, soft market through the next renewal cycle.
And what about you, Jodie? How do you see the current market?
Yeah, I don't foresee the softening market will rapidly revert to a hardening cycle, but we do know that the insurance market is cyclic overall. There are aspects which I'm keenly aware of and waiting to see play out over the next couple of months. A lot of reinsurance protection is renewed on the 1st of January, so I'll be interested to see if there are any changes implemented by insurers in the first quarter of the new year. Specifically for Queensland and natural catastrophes, like Melissa mentioned, we're heading into our storm and cyclone season, so I'm always conscious of how this may play out and directly impact my clients. We've already had some significant hailstorms in the last month or so if there is a large accumulation of losses through the summer months, and then also potentially around the world, there could be a shift in insurer appetite about the coverage being offered for those risks.
And Martin, you get the final word here. You think there's quite some way to go in this softening we're experiencing?
Yes, the composite rates, all lines is stabilized. So that means we might have reached the bottom there. But for property rates, which is the main focus of this panel, yes, we've still seen the trend is still reducing, and all other things are constant. If we probably haven't hit the bottom of the cycle just yet, but if we had to experience massive hailstorms or some nat cat, that's going to change. That definitely has an impact and will have a bearing on the rates.
Well, thanks very much, Martin, and thanks to Jodie and Melissa, and thanks to you too for watching Insurance Business TV. Bye for now.